Well, confidence is not a word to describe the bond market. For U.S. Treasuries, as we discussed yesterday, there has been a global sell-off in bonds, which pushes interest rates higher. To talk more about what he thinks that means is Jim Awad, Managing Director at Plimsol Mark Capital. Welcome back to Arise Xchange, as always, Jim.
Thank you. My pleasure.
We don't get to talk about bonds all that much on the show. Not all that sexy or exciting, but they're a significant indicator for what people think about the world's economy. And there has been a rally. Has been a sell-off, rather, in bond prices and a rally in yields.
Yeah, rather dramatic. Almost 25% increase in the rate on the 10-year Treasury in a short period of time. And it's not only the increase; it's the rapidity of the increase that really shook the financial market.
What do you mean by that?
Well, that it went up so fast. You went up 25, 30% in the rate of interest in a period of a week. And basically, it's negative for the following reasons. Number one, it's a tightening of liquidity in the United States. It raises interest rates. It suppresses business activity at a time when it leaves the Fed at zero, and the Fed really would like rates to stay low enough, long enough, so they can get off zero.
It's an interesting point because this is now outside the Fed's control.
Absolutely, it's an unintended, uninvited tightening of monetary conditions, which reduces the Fed's options because it's going to suppress business activity. And were it to roll us over into a recession at any point, the Fed wouldn't have any options. The second thing it does is it reduces stock valuations because PE ratios on stocks are the inverse of interest rates. And the third thing it does, because it's so sudden and so inexplicable, unexplainable, it basically rattles confidence in the financial markets in general.
Okay, so what is it telegraphing? Because people are moving out of equities they're moving out of equities and they're moving out of bonds.
No, well, I think in this particular case, I think that Dodd-Frank had reduced the ability of the bond market to supply, of the participants in the bond market to supply.
Dodd-Frank is regulations for the banking industry.
Right, so the big banks no longer carry a lot of bond inventory, which reduces the liquidity in the market. So I think what this mostly was technical trading within the markets, that the German yield had gotten to about zero. And Bill Gross and the U.S. Treasury trades along with the German yield. And Bill Gross came out a week ago and he said that the German bond was the greatest short of the century, which means he thought the price was going to get down and yields were going to go up. And so everybody who thought that German interest rates were going to go negative, as opposed to the 5 or 6 basis points, got caught in a short squeeze, and U.S. investors got carried along in that same trade. So I don't think it speaks to a lot of inflation. I think it's going to reverse itself. But those who are inflation believers think it's the beginning of an inflation outbreak.
Because this is a good hedge against inflation.
Yeah, well, that they think you shouldn't own bonds and you should sell your bonds because inflation's, oil's going up, the economy's strengthening.
This economy, there was a time where a certain class of investors liked yields.
Yeah.
This economy really is not about that anymore.
Well, the market can handle a gradual increase in interest rates if the economy is improving. What the market can't handle is a rapid increase in interest rates that's a surprise against the wishes of the Fed, because that's dislocative to the credit markets and the economy.
So we've been seeing a mild sell-off on Wall Street. The stock's not doing a whole bunch. What are investors waiting around for?
Well, you want to watch the yield. It can't go up. The market will not go up if yields continue to go up. So you want to watch the U.S. yield. You want to watch the German yield, since they trade in tandem. And then tomorrow, you definitely want to look at the retail sales numbers.
Does this change your business a little bit in the sense that because of this surprise, your outlook on the market?
It makes it more difficult because we have a large portion of older conservative clients where there's a reasonable percentage of their portfolio in bonds. And now you have a situation where both bonds and stocks are going down.
Where do you put people?
Well, I sort of think the bond market's going to get its act together and stabilize. And once that does, then stocks can follow the economy, which will lead to a gradual increase in stock prices, single digits, and stability in the bond market.
Jim Awad, as always, thank you.
Pleasure.
Coming up, it's being called a blue brawl, the president against Democrats over an Asian trade deal. You're watching Arise Xchange. Stay with us.